Open. Blackstone is moving to IPO a data center REIT, with early focus on the DC corridor, Northern Virginia and adjacent markets. That headline gets read as an exit story. Blackstone bought, Blackstone built, Blackstone is monetizing. That's the retail read. The institutional read is different, and it matters more if you're actively deploying capital into private data infrastructure right now. When a vehicle of that scale files for a public offering in this asset class, it doesn't just price Blackstone's assets. It creates a publicly traded comp stack that every sell-side broker, every seller's advisor, and every appraisal desk in the country will anchor to within 2/4 of that IPO pricing. That repricing cascade flows from public to private. It always does. It happened in industrial with Prologis. It happened in net lease with Store and Vici. And it is happening right now in data centers. The question isn't whether seller expectations adjust, they will. The question is how much runway exists before they fully do, and where the basis asymmetry still lives. That's what this video is about, the data layer. Let's start with what the public market is actually pricing. The two primary public data center REITs, Equinix and Digital Realty, are currently trading at roughly 26 to 28 times forward EBITDA and somewhere in the 20 to 22 times forward AFO range, depending on the week. Equinix's market cap is sitting north of $70 billion. Digital Realty is in the $45 to $50 billion range. Those are the comps every institutional seller is going to hand their banker when Blackstone's vehicle starts its roadshow. Now look at where private transactions have been clearing. According to CBRE's 2024 Global Data Center Trends Report, primary market colocation assets, stabilized, hyperscale leased, Northern Virginia or Silicon Valley vintage, have been trading in the $8 to $12 million per megawatt range on in all, in basis depending on lease tenor and credit. Green Street's data center coverage, which they've expanded meaningfully over the last 18 months, has been flagging that private market cap rates for stabilized Northern Virginia product have compressed into the low 5s, occasionally touching high 4s for the longest duration hyperscale paper. The transaction that sets the clearest precedent in the development to stabilized pipeline is QT's Realty. Blackstone took QT's private in 2021 at approximately $10 billion, about 27 times EBITDA at deal close. They've been building and leasing aggressively since. This IPO is the back end of that trade, and if it prices anywhere near current public comps, Blackstone will have demonstrated a full-cycle return on a development-weighted data center portfolio in under 4 years. That is the case study every broker is going to walk into seller meetings with. What matters for the private market is the gap between where pre-leased or partially stabilized assets are being offered today and where they'll be offered after that IPO prints. JLL's 2024 data center outlook estimated that Northern Virginia alone has over 2 gigawatts of capacity in some stage of development. The absorption rate is real. Hyperscalers signed over 5 gigawatts of new leases globally in 2023 per CBRE, but the development pipeline has been moving faster than power delivery can support. That constraint is the fulcrum of the entire repricing story, the mechanism. The reason this window exists right now, and won't for much longer, comes down to 3 converging forces: power delivery timelines, capital stack mismatches at the developer level, and the lag between public market pricing and private seller psychology. On power, the dominant constraint in Northern Virginia, Loudoun County, Prince William, the immediate Ashburn adjacencies, is grid interconnection. Dominion Energy's queue for new large load interconnection in that corridor is measured in years, not months. Northern Virginia's utility commissions have been explicit about moratoriums and caps on new large load connections in certain substations. That physical constraint is what pushed institutional money into adjacent markets: Manassas, Gainesville, the I-81 corridor in the Shenandoah, and further out into secondary Virginia, Maryland, and West Virginia markets where brownfield industrial sites with existing 138 kilovolts or 230 kilovolts utility infrastructure represent real basis advantages. On capital stack mismatches, a meaningful share of the development stage data center pipeline was capitalized in 2021 and 2022 at debt costs that no longer exist. Construction loan spreads that were 200 to 250 basis points over SOFR in that era are now clearing closer to 325 to 375. Sponsors who underwrote to a blended cost of capital in the low 5s are now staring at refinancing risk or extension risk on construction facilities. That creates motivated sellers at the development stage level, not distressed, but willing to transact at a basis that doesn't yet reflect where public comps are heading. The Blackstone IPO closes that gap. Once it prices, sellers have a number to anchor to and they'll use it. On seller psychology lag, this is the oldest dynamic in private real estate. Public market repricing takes 90 to 180 days to fully flow into private seller expectations. We're in that window right now. Once Blackstone's roadshow materials are public and the deal prices, that lag closes fast. Where mid-market capital fits, the sub-$100 million opportunity in this environment is not stabilized Tier 1 Northern Virginia product. That market is fully discovered, and you're not going to outbid Blackstone, Brookfield, or KKR on a stabilized 50-megawatt campus in Ashburn on price. You don't want to. The specific opportunity I'm tracking is development stage or pre-stabilization assets in secondary power-constrained markets, sized in the 5 to 20 megawatt range, where the sponsor has site control, utility interconnection agreements in hand or in final negotiation, and at least one executed LOI or pre-lease from a creditworthy tenant, ideally a cloud subtenant, an enterprise colocation user, or a federal.adjacent operator. Given the DC corridor's government data concentration, the structure that works in this segment is either preferred equity or mezzanine behind a senior construction facility, or a JV co-GP stake where my capital comes in at the development basis before a stabilization and recapitalization event. Target basis in that structure is $4 to $7 million per megawatt all in, well below where stabilized assets are clearing, with a value creation event being either a lease up to institutional quality occupancy and a sale at $9 to $12 million per megawatt, or a recap into a longer duration vehicle post-stabilization. The geographic targets that still carry asymmetric basis are secondary Virginia markets outside the Ashburn core, specifically where existing industrial or manufacturing brownfield sites have 69 kilovolts or higher utility drops already permitted. Select markets in the Carolinas where Duke Energy's interconnection queue is shorter, and specific submarkets in the Midwest where fiber convergence and flat land costs create a cost per kilowatt built advantage over coastal markets. The subsegment that is specifically mispriced right now is the 8 to 15 megawatt edge to regional colocation facility serving enterprise and mid-market cloud users, not hyperscale. Hyperscale deals are 50 megawatts and up. They require balance sheets that operate in billions, and the lease structures favor the tenant. The enterprise colo market clears at higher per kilowatt rents, has shorter lease terms but better mark-to-market optionality, and operates at a deal size that is genuinely actionable for a capital allocator moving sub $100 million into a single transaction. Counter positions and risks. The bear case here is not vague, it has three specific components, and at least one of them is right. First, power delivery risk is real and it is not fully priced by optimistic sponsors. If a site has a utility interconnection agreement, but that agreement is tied to a substation upgrade that runs 36 to 48 months, the development timeline and therefore the capital carry risk is substantially higher than the pro forma shows. I have seen multiple development stage pitches in the last 6 months where the power delivery assumptions were aggressive by 12 to 18 months, at construction loan costs of 8% all in. That matters enormously to your return stack. Second, the hyperscale tenant concentration risk is real. If your stabilization thesis depends on a single hyperscale pre-lease and that counterparty re-evaluates their edge deployment strategy, which Microsoft, Google, and Amazon have all done at various points in the last 24 months, you have a lease-up problem on a highly capital-intensive asset. Single-tenant data center development is not a business I want to be in on the development side without a senior secured position or substantial basis cushion. Third, the public market comp spread can go the other way. If Blackstone's IPO price is below the whisper number, or if rates stay elevated longer than the forward curve implies and compress REIT multiples broadly, the private market comp lift I am describing here either shrinks or delays. The repricing thesis depends on the IPO pricing well. If it stumbles, the window extends, which is not catastrophic but does change the urgency of the timing call. The position I'm taking, specifically, my team is actively evaluating 2 development stage assets right now, neither in Ashburn core. One is a brownfield industrial conversion in a secondary Virginia market, approximately 12 megawatts buildable, with a 138 kilovolts utility drop already on site, site plan approved, and a signed LOI from a federal contractor as anchor tenant. The all-in development basis is in the $5.2 million per megawatt range, at stabilized comps of $9 to $10 million per megawatt, conservative relative to where primary market product is clearing. The return profile on a preferred equity or co. GP structure is compelling before the Blackstone comp lift even flows through. The second is a ground-up development opportunity in a mid-Atlantic adjacent market, where a regional carrier has committed to a long-term colocation arrangement as an anchor, and the sponsor has successfully developed and sold 2 prior facilities to institutional buyers. Sponsor track record in this asset class matters more than almost any other variable. Construction complexity, utility negotiation, and hyperscaler relationship management are highly operator-specific skills. I will not invest in development stage data center without a sponsor who has at least one full-cycle transaction in the asset class. In both cases, the structure I am pursuing is either mezzanine debt with meaningful equity kickers or a co-GP JV with a promoted interest tied to stabilization and recapitalization milestones. I am not buying stabilized product at 5 cap in Northern Virginia core. That trade is done for anyone not operating at institutional REIT scale. Close. The Blackstone data center REIT IPO is not primarily a Blackstone story. It's a comp-setting event that creates a narrow, time-limited basis advantage for anyone moving into pre-stabilized data center assets before those comps fully absorb into seller expectations. The specific opportunity is development stage, secondary market, enterprise-oriented colocation product in the 8 to 15 megawatt range, structured as preferred equity or co-GP JV, acquired at a basis that implies a 60 to 80% gain to stabilized institutional clearing prices. The risks around power delivery timelines, tenant concentration, and IPO pricing are real. Underwrite them explicitly, not optimistically. If you're a sponsor with a development stage data center asset in the mid-Atlantic or adjacent markets, a broker with pre-vetted product in this segment, or a principal looking to co-invest alongside structured data infrastructure positions, DM me at @BrodiOfficial. I route every inquiry personally.